Ladies and gentlemen, we got a lot to dive down into today as I'm going to be breaking down the stocks I'm buying September of 2022. This includes a basket of ETFs, and I want to break down the components because you'd be surprised at how often the top 10 stocks in these ETFs change. We're going to talk about one Warren Buffett stock that he has been buying over the last quarter that is still a fascinating story to make some money in the coming year. And then, of course, a broad view strategy of how you should kind of invest with your portfolio, as I've noticed something a big YouTuber did that I don't do, but I want your opinion on it. And if this is a conversation you can appreciate, in return, guys, all you got to do is hit that like button because I know you like talking about stocks as much as I do. And if you want to support the channel, you can always come to investoriches.com, where you can buy some of my portfolio tracking spreadsheets, talk with me one-on-one, and just take some general courses, anything else in between here, folks. But today was a rough day in this market. Baby, I mean, take a look at this, guys. It's been continual red ever since Jerome Powell, after being the money printing machine that he was. It's like he just went out and now he's vacuuming up the mess that he threw into the economy, and it's hurting all of us, from real estate to stocks. It's just been critically brutal. I mean, Bitcoin is just getting devastated, and I want to talk about that for 1 second, and not Bitcoin specifically, but something related to someone talking about Bitcoin, because it's down in the 19,000 range again, places no one thought we'd see. But this has to do with Andre Jacques. So take a listen. This is really interesting to me.
First, let's talk about Bitcoin, because its market cap dropped to $385 billion, or less than $20,000 per Bitcoin. That's a price level that a lot of investors never thought we'd see again. But as a reminder, if you're a crypto investor, just remember, prices could always go way lower than you ever thought possible. So just be very careful. And it's also why I never invested more than 10% of my net worth at my cost basis, because it's extremely risky. Now, when it comes...
Okay, so I really wanted to fixate on that because, from my understanding, Andre Jacques, when crypto was at its peak, I think he had something like over 50% of his portfolio just in crypto alone. And he states here that he didn't put any more than 10% of his net worth or his cost basis into crypto, and this guy wouldn't take profits. I don't think he's taken any profits on his crypto portfolio, and this is something that I widely always recommend because it's how I built such a large portfolio, is taking profits on Tesla, Canopy Growth Corp, MindMed, Apple. Like, I'm always kind of skimming really high flying stocks in my portfolio down to just kind of equal weight and continue to diversify to offer stability, and I don't think that's something he's done here. And I find it convoluted that he said his cost basis was only 10% of his portfolio, so I think it ballooned so massively, and a lot of people think to themselves, well, I don't want to sell, I don't want to pay tax, I don't want to deal with this, and I've got enough other investments over here, you know, because I think he's got $500,000 in a dividend portfolio. But it always just kind of irks me a little bit when some people just have really concentrated portfolios because of capital gains and growth, and they just refuse to sell it. But that's just me. I know a lot of people think differently. It's just my opinion, but I'd love to know what you think about that in particular. But let's move on here and talk about Activision Blizzard here. Big video game fan, always will be, always has been, and I have been watching this thing like a hawk, considering Warren Buffett has been gobbling this up over the last couple quarters here, primarily based on the Microsoft deal. This thing is going to get bought out at something like a $68 billion market cap. And the reason this is beautiful is because if you're buying it today and you presume that buyout's going to happen, it doesn't matter how low the stock price goes, you're basically going to make an immediate 11 to 12% return at the current price of the stock. And I find it interesting that if Buffett's buying this, you know, this thing as a company itself has done pretty great from a cash flow perspective. You know, from 2018, they went from $1.6 billion in free cash flow to about $2.3 billion for 2021. So you're getting a relatively stabilized business with almost a guaranteed return if that buyout happens. And if you think that buyout's going to happen, I mean, I think it's approved for, well, not approved just yet, but it's contracted for June of 2023. So it's a little under a year away. And every dollar you put in here, man, you could just be guaranteeing yourself almost a 12% return by the time that buyout comes in. And I think it might get converted to a Microsoft share. So it could be a fun way to buy Microsoft at a reduced rate. So I don't know if that's Buffett's plan here, but I'd love to know what you think about the Activision Blizzard deal as well. But let's get into this by talking about the ETFs that I'm buying and some of the individual stocks I'm looking at, and just how I'm trying to restructure my emergency fund, because the month of September is going to be what I'm calling my finalization month, where I set everything up in a manner that's going to become truly passive, and everything is going to cost average into itself, and I'm only going to be doing incremental things from there on in. And of course, I'm building out a smaller cap, riskier portfolio, but primarily I'm trying to get this retirement stuff fully done and just ready to take me to where I want to be 10 years from now. Let's get into the S&P 500, guys. This will be the most boring ETF because you all know about it, but don't worry, we'll talk about the dividend ETFs in a sec. Year to date, VOO is down 16.55% here, guys, on a 5-year basis, still up almost 61%. The top 10 holdings have been shifting around, but on the top 10, it's the lower half of those because we can see Johnson & Johnson, United Health Group, and Nvidia are these three lower ones that are really competing to stay on here. You'll remember even a quarter ago, or just over a quarter ago, I think Facebook was still in the top 10 list. But right now, guys, Apple is making up about 7.12%, being the largest company in here. And like the other ETFs we're going to talk about, I pay a lot of attention to the dividend because I am primarily a passive dividend investor here. So what I'm trying to do is I want to be able to draw against these dividends as part of my emergency fund at any point in time. And I love the VOO because the dividend yield is low, but I know I could utilize it without it hindering the continued growth and getting a decent return over the next 10 years just with the stock price itself. So let's talk about the dividend income ETFs that are going to complement the S&P 500's VOO. And we're talking about some of my favorite stabilizers with VYM. This thing is now down 6.85% in the current recent sell-off of this market. Again, really outperforming the S&P 500 to the downside. But the point of this ETF isn't to get as much growth. Obviously, more volatility should expect better returns, and lower volatility is something I would look for income producing stocks, right? So let's talk about VYM top 10 holdings because this is where I get the concentration of some of these energy, healthcare stocks with obviously Johnson & Johnson, ExxonMobil. But I think the reality of this ETF is that the two biggest holdings are in financials and healthcare, which are obviously great income aspects of the market. You can take a look at the dividend growth of this. I think has actually been better than the S&P 500 slightly, but that's because these are like dividend aristocrat focused kind of companies. So taking a look at the lowest payment that we got back in 2013 was around 36 cents. In the recent quarter, guys, the lowest payment was around 66 cents. So almost a doubling just within a decade. So that's what we want to see out of these dividend guys. So if we're getting like a 3 to 4% yield starting today, we can expect that in a decade that 3 to 4% should be closer to hopefully 6 to 8% would be my best guess, but that's what I'd always kind of shoot for, right? So this comes into the same kind of clarity with Schwab US Dividend Equity ETF, ticker symbol as SCHD, and this one has crushed the 5-year. Year to date, obviously, again, more volatility. You expect a better return, but you should expect more downside, so it's not performing as well as VYM, but I find it trades in parity almost. But the top 10 holdings here are also very intriguing because we're talking about Pepsi, Texas Instrument, Cisco, Coca-Cola, Home Depot, Merck, Amgen, International Business Machines, Broadcom, Pfizer. So you can kind of see the overlap a little bit between VYM and SCHD, but they seem to weight a lot of these tech-related companies that pay dividends because the information and technology makes up about 20%, with financials at 20%, consumer staples at 14.6%, and healthcare at 12%. So this is a very nice diversification set, and I love how all of these can kind of pair with each other while being different to offer further diversification. And again, from the dividend growth rate, going back again into 2013, the lowest period there was about 0.1, about 19-20 cents, whereas the lowest period right now is about 0.518. So I mean, we're talking about well over a doubling, like almost, I would like to say a tripling, but we're not there yet, but well over a doubling of the dividend in 10 years. Combining those three stocks together is my exposure to the US currently. So we got VOO, VYM, and SCHD, and on the Canadian side of the border, I am still highly fixated on one stock. I have compared this thing 9 ways to hell with every other Canadian ETF that exists out there, and it's the one that I continue to just fall in love with, which is the Vanguard FTSE Canadian High Dividend Yield ETF. Ticker symbol is VDY. Year to date, it's only down 1.79%, so by far the least volatile this year of all these other ETFs we just looked at. Top 10 holdings are much more concentrated, but Canada is a much more concentrated economy. So let's be real. Royal Bank makes up 13% of this ETF still. Toronto Dominion Bank, Enbridge, those three stocks make up about almost over 33 or 1/3 of the entire ETF, followed by a bunch of banks. I mean, this is, again, highly fixated on, if we can see here, financials making up 53%, energy at 28%, telecom at 9%, and utilities at 6.5%. And I've gotten a lot of flack because of the concentration of this ETF, but I'm going to talk about that in a sec because first and foremost, the dividends here, guys, same sort of deal as those other ETFs. We get a nice doubling typically over, a decade's period. And that's some of the problems that I'm seeing with these other Canadian ETFs. I look at a lot of them, guys. Some of you pointed out things like XEI. This is one that I wanted to add, and I like the chart of it. It's very stable. Year to date, it's down only 0.54%. But when I take a look at the weightings, they're beautiful with Enbridge, Royal Bank, BCE, and they're all at like 5% weighting. So it's not basing these really off market caps. It's just an equal weighted fund. So I'm looking at this and I'm like, okay, the diversification is amazing. The stocks this thing holds, absolutely incredible. Everything from Hydro One, Algonquin Power, my favorite utilities. Some of my REITs are in here. I love this. Okay, I get it. The stock performance is relatively okay. So is this thing, it's yielding like 4%. The expense ratio is super low, but where I lose interest right away is there's no dividend growth. I don't know why, considering the dividend aristocrats and the amazing companies this ETF holds. It's something I'm trying to research more into, but there's like no dividend growth out of this ETF in the last decade. And the whole point of starting with a 3 to 4% yield is that you're owning those companies that are able to double it every decade, because in a 20 or 30 year period, especially if you're reinvesting the dividends, that compounded rate of return gets like insane. So I really need to make sure that my ETFs have some form of an increase in dividends. So I'm going to look more into this and try and figure out why that is the way it is. But seeing the structure of my setup here, guys, like I've got a decent amount of money in SCHD and VYM, about a split of 23,000 US in literally both of them. And I love it too, because the share price is low enough and the quarterly payouts are high enough that I can set it up on a drip. I don't have M1 finance. I can't buy fractional shares. So I'm getting about $1,650 between these two ETFs alone. And then in the TFSA, guys, the only other thing that sucks is I can really easily drip VDY, which I'm now down on. These were all green literally like just a couple weeks ago until the Fed opened their mouths. Poor Jerome Powell, man. What a job. But yeah, I'm down on these positions still, but it's crazy how much money you actually have to own a VOO or like SPY to get enough dividends to actually repurchase one share in a quarter. Because right now I'm only making about 1,139. Now, I do own a lot more VOO in my corporation, but still the fact of the matter is I'm making that 1,100 divided by 4 is what, like, it's still under $300 a quarter when I get that payout. So I mean, it's not enough to buy one share. So I'm just gonna let that thing sit there. Maybe when I contribute at the end of the year, I will add some more. But finally, what I'm most fixated on here, guys, has to be my emergency fund. So this is kind of my emergency fund goal and how I plan on structuring my emergency fund of around, it's gonna be like $25,000, $30,000. And I want to divvy it up between this new world of interest rates. You remember like a year or two ago when people are like, why would you put money in a savings account? The interest rate's like 0.5%. You could easily just make more money off stock market and real estate because it never stops going up. And now all of a sudden the story's flipped and people are like, don't put money in the market. Interest rates are so high, you can get upwards of 4, 5, and sometimes even 8%. So what I'm trying to do here is balance this out. So my emergency fund is not only accessible, but over certain periods of time, it will make a higher interest rate and continuing to cash flow my own cash that I'm not really utilizing. And this is the interest rates I'm currently getting from my bank in a basic savings account. Now, I like these basic savings accounts because I can draw against the money at any time I want. And right now, the base rate, I think, is 1 or 1.5%. But if you leave it in here for these periods, these premium periods, you get like an extra percent or sometimes more. So I primarily use the 90-day, and I reset the 90-day with about $10,000. So it'll make me $220 a year, but I reset it every 90 days. So that way, if an emergency happens, 3 months is not that long to wait. And especially considering, we're already halfway through my first premium period, that I could wait an extra month if an emergency happens and just put it on a credit card, so that way I'm not losing that extra percent. That's one thing that I'm doing, but I'm also trying to make money go a little bit farther than that by looking at something I've talked about before, which is these GICs. GICs are really interesting because they're guaranteed investment certificates. They're zero volatility, guys, and on a 1 year, you can get 3% that is withdrawable after 30 days with no penalty, which is just incredible. So the 3% to me is the base rate you could absolutely get out of the market right now, and that's what I'm thinking about doing with another 10,000 instead of leaving all that at 2.2% when I can get 3%, and again cancel it after 30 days. It's just locked up for 30 days and that's it. So the promotional period, things get really interesting. I've talked about these before, but the most interesting one is the 14-month. So basically 1 year and 2 months, you can get 4.4%. And this is annual rate that's compounded and it's paid at maturity. So you can't touch these. These are investments. Once they're locked up, they're locked up. But as I mentioned before, what's really neat is if you have 30 grand, you put $10,000 10,000 somewhere, it's immediately accessible. You're going to get a low rate like 2%. You take another 10,000, you lock it up at 6 months, or even on the 1 year at 3%, but it's withdrawable. So now you're getting another extra percent, and that way, you get these periods where you can always access the money. So if you want a 6 month, so let's say my maturity on my basic savings is 3 months, so we put another 10,000 at 6 months, and we put another 10,000 at 14 months, and then that way you pair it with a credit card, and an emergency happens, every quarter or every 3 months, basically, you're getting more money from GICs. It's just kind of the way I'm thinking about it right now, because it should maximize the interest rate, bringing in, if you average all of these together on $30,000, if you can get 3 to 3.5% across the entire board, I mean, that's pretty good. That's almost an extra $1,000 a year on an emergency fund with zero risk investing, like whatsoever, guaranteed investments, right? Which is just kind of mind-boggling, and it's something that, again, didn't exist a year ago, and is something you should probably be paying attention to right now, especially considering the Bank of Canada is going to be doing another interest rate hike very shortly, and I think it'll be the last one for the year potentially. So I'm just going to wait and see what this next interest rate hike does for these savings account interest rates, and then I'll probably finalize up exactly how I'm going to structure that. But I want to pass the question off to you. I'd love to know what you guys think about all of this in that comment section below, and what stocks are you buying this month? I'd love to hear about it. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.